So we're going to look at the personal computer market, the oil and gas market, and the stock market through the lens of the demand and supply model. Well, being that we're in Silicon Valley, the personal computer market is a really important one for us. Many of you will work in this market as suppliers when you graduate, and certainly we all interact in this market as consumers. The personal computing has been probably the most innovative sector of the economy in the last 20 years. But surprisingly, the price of computers has fallen over this time. Well, it might be surprising. It might not be. As consumers become richer, they demand more computers. And so that by itself would tend to increase the price, right? The demand for computers would increase. And if supply stayed the same, equilibrium price would increase. But, of course, supply of computers didn't stay the same. There has been a lot of innovation, especially a lot of innovation here in Silicon Valley, but all over the world in computer production, and that caused a big shift rightward in the supply of computers. And so we moved from this equilibrium point at D1 and S1 to this equilibrium point at D2 and S2. So this is just one illustration of how you can use the demand and supply model to illustrate a market, the computer market. The next market that we'll talk about, crude oil and gasoline, also is a really important one for the economy. And I remember when I first moved to California in 2008, we took a road trip down to Southern California over 4th of July weekend, and gas prices were the highest I've ever seen them at $5 a gallon. And that was quite surprising, right? Because we'd never seen gas prices that high before. A few months later, the economy went into a big recession, right? And so I think those events are probably related. This is my own hypothesis about the Great Recession that in some ways we're still recovering from. But to illustrate first that increase in the price of gasoline, most commentators or observers of that market think that the increased demand for gasoline, especially by people, for example, in other countries like China, increased the demand for gasoline, and then this increased the price. Right? So the price of a barrel of oil went from $35 to $140 as a result of the increased demand. So drivers and other people who use oil are going to pay more for it. That's what we see here in the market for oil. But there are many other markets that use oil and gasoline in their production process, right? So for example, if you grow strawberries and then you take your strawberries and drive them to the farmer's market to sell them, you need to put gas in your truck before you get there, right? So what's that going to do to the supply of strawberries? Will decrease the supply of strawberries, right? Because now the cost of producing them, selling you strawberries doesn't only entail growing them, right? They have to be transported too. So that cost of supplying strawberries went up, and that caused a leftward shift in supply. And so one of the consequences of rising gas prices was also higher strawberry prices and higher prices for a lot of other things. There's one interesting aspect of this gasoline story that's not addressed in the book, but I think is really important for understanding what caused one of the major causes of the Great Recession. So you know that the Great Recession, the first thing we saw was the subprime mortgage crisis, right? And what does that mean? It means a lot of people who had purchased homes defaulted on their mortgages, right? They realized that they were paying more. The mortgage was more than their home was worth, so it didn't make sense to pay it off, right? And so they made a rational decision to default on their mortgage. But I think the rise in gasoline prices probably contributed to that, because especially in the Bay Area, as the prices of homes rose throughout the 2000s, people started moving farther and farther away, right? So some people moved to Los Banos, which is like around a 2-hour drive from San Jose, and other far away areas, and then commuted to San Jose and other Bay Area locations, right? But let's say you're thinking about buying a house in Los Banos. The rent is so expensive in San Jose, so you want to buy a house in Los Banos. All of a sudden, the price of gasoline goes up a lot. Are you going to be more or less likely to buy that house? Less likely. So I'm going to draw another diagram here, and this will be quantity of houses in Los Banos, and this is the price of those houses. So here we have demand and supply for houses, but when the price of gasoline goes up, it causes the demand for the houses to fall. And then what happens to the price of houses? We see that it goes down, right? From here to here. So the price of houses in Los Banos went down, and in other markets also went down as a result of the increase in the price of gasoline, right? And so then people who had purchased houses in Los Banos saw the value fall, and then they defaulted. Then that caused banks to face problems, right? They were making losses. So the banks, some of them, went bankrupt, and before you know it, we're in a very serious recession. So I think it's not trivial to say that the oil market had a major impact on the real estate market, which in turn had a major impact on the financial markets, right, the banking industry. So if you are looking for an explanation of the Great Recession, there are others to consider, but that's not a bad one. Okay, the final market we'll consider is the stock market. And so before we talk about how that demand and supply model looks, we should talk for a few minutes about how the market operates very generally. So some companies, like small restaurants or retail shops, are just owned by a single individual, or maybe they have a couple partners. But the largest companies in our economy are corporations, and they are firms owned by shareholders who own stock in the firm. So maybe some of you own stock in firms, or certainly many of your parents may own stock in firms, right? If you own mutual funds, then you have stock in many firms, effectively. So in the U.S. economy, households actually own a lot of the firms, right? Through holding stock. And so what's stock? Well, maybe I can illustrate by saying, I'm illustrating we go from I own a restaurant and I turn it into a corporation. So if right now I own my restaurant, it's doing really well, I want to take it public, turn it into a corporation. So I say, okay, I'm going to split my restaurant up into 100 shares. Do you want to buy 1% of my restaurant? If you do, you buy 1 share. Or you could buy 20 shares and be a 20% owner, right? So it's just like that. And when I sell you the share, you give me money, I've earned money, right? By selling part of my business. But then after you buy the share, you may sell it to someone else. That's a secondary exchange, right? And I may not even be aware that you exchanged that share. And I don't make any money after you exchange that. So I'm essentially done after I sell you the initial share. So that's called an initial public offering, when the companies first decide to take their companies public, which means go from being a private company owned by one or a few individuals to a public company that's owned by many individuals whose shares are traded on stock markets. And so there are a few stock markets in the United States, including the New York Stock Exchange. And in the New York Stock Exchange, they have a floor of traders who buy and sell shares, usually on the behalf of smaller investors like you and me. There's also NASDAQ, which is electronic transactions. Transactions are mediated electronically. But around the world, there are many, many stock exchanges. Well, we can analyze this market using the tools of supply and demand. And so here we have just a supply and demand diagram. And the example that we're considering here is Intel. So suppose they announce a new generation of computer chips. What's going to happen in this market? So Intel says, we just invented a great new product. If they are very profitable, then one thing that they'll do, possibly, is share that profit with their shareholders, right? So if you, and this is called a dividend. If the company, the corporation, pays out some of its profits to its shareholders, that's called paying out a dividend. And so we hear that they have invented a new product, and we are excited about the prospects of getting paid out larger dividends. What's going to happen in this market? This is the market for Intel shares. There'll be an increase in demand, right? And why? Because if I'm in the market looking for some shares to buy, these now look more attractive, right? Because I think that they're going to pay out a profit. But what will then happen to the price of shares? It rises, right? We see that we go from this point to this point. So the equilibrium price rises maybe to $30. But keep in mind, at the same time, so where would I buy these shares from? It would be from someone who already owns them. The people who already own the shares are going to be less likely to sell them now that this good news came out. So at the same time, supply will fall. So supply falls and demand increases, and the joint result is to move from point A to point B to point C, right? So the price of shares will go up, right? Both because investors demand more shares and also because the current owners supply fewer. And this is exactly what is shown here. There is one somewhat unique aspect of the stock market. It's true for all markets, but especially in the stock market, expectations play a really important role. If you're a serious investor, you don't just wake up in the morning, open the paper, and see, oh, Intel invented a new product. I'm going to buy Intel shares, right? Instead, what you're doing is you're following this industry very closely. Maybe you have friends who work at Intel, right? So you're doing intense research to determine what Intel is doing. So do you think such a sophisticated investor will be surprised to learn that Intel is coming out with a new product once the newspaper reports on it? If they're surprised, then they're not very sophisticated. In other words, they haven't done their homework. In other words, it's likely that the investor finds out about the new product before the newspaper reporters do. The investors have a strong financial incentive to be aware, right? So if the investor expects that Intel is going to announce a new product, the demand will increase, right? And the supply will decrease if they already own the shares, for investors who already own the shares. Then Intel announces it. And what happens? Maybe nothing, right? The curves have already adjusted because the investors, the market participants, already expected they're going to announce this. So when they actually announce it, nothing happens, right? In other words, these expectations are already reflected into the price of stocks. This is a very important aspect of the operation of stock markets. And the consequence of it is it's very difficult to make money in the stock market. Because as soon as you realize something and you think you can act on that to make money, other investors probably already have. Right? By the time the news comes out, it's too late.